Hi everyone, I'm Radhika Bhangudia, Assistant Manager Direct Taxes at Advith Consulting. Today, I'm here to discuss some of the relevant provisions that got amended in Finance Act 2020 with respect to individuals. These provisions got amended in March 2020 and they are generally applicable for financial year 2021, for which we'll be doing the compliances right now. So there is a time gap of around a year when it was implemented and when you're supposed to apply it in your practical life. So let's discuss some of the relevant amendments so that you file your returns effectively and you advise your clients as well to file them effectively. So the first change that came out was introduction of the new tax regime. The option between the old and the new tax regime is given to the individual to choose. So how will a person choose which regime he should go for? So first he should know the difference between the two and then which one is beneficial to that person. So the first difference is the old tax regime has less slabs but higher rates. The new tax slabs have more slabs but less rate. The second difference is Income Tax Act offers 70 plus tax exemptions and deductions to a person who is opting for the old tax regime. Now, if you go for the new tax regime, you will not get the benefit of all these exemptions and deductions. Some of them very famous are if you are a salaried employee, you get a deduction of 50,000 rupees as a standard deduction. If you are repaying housing loan, if you are availing HRA, if you make some investments that are eligible for ATC deductions, etc., these will not be available to you in the new tax regime. So you just have to compute your tax liability in the two regimes and then determine which one is beneficial. Now the second question that comes is it possible to choose between the regime every year? So the answer is, if you are having income from business and profession, PGBP income. If you have PGBP income, you have the option to choose the regime only once till the time you have business income. Suppose I choose new regime for financial year 2021 and then I will have the option to go back to the old regime only once till the time I have business income. But people who are having income other than PGBP income, like other sources income, salary income, etc., they have the option to choose the tax regime every year on the basis of which one is beneficial to that person. This was all with respect to the new and the old tax regime. The second change is residential status. There are three types of residential status: resident, deemed resident, and non-resident. It is very important to determine the residential status appropriately because on the basis of residential status, your taxability of income is determined. The rules to determine the residential status is changed from this Finance Act and it has become a little overlapping. So it's a little confusing. I have broken it down into various examples. The first one is if any person, whether he's a resident, non-resident, Indian citizen, foreign citizen, coming to India or going out of India, any person. If his stay in India is more than 182 days in a financial year, he becomes a resident of India. If his stay is less than 60 days in any year, he becomes a non-resident of India. The third category is a person whose stay is more than 60 days and less than 182 days. In that case, a person who stays more than 60 days in that financial year plus more than 365 days in the past 4 financial year, he becomes a resident of India. This third rule has two exceptions. The first exception is if his stay in India is more than 182 days plus 365 days in past 4 years, he becomes a resident if he is an Indian citizen who's traveling outside India for employment or as a member of Indian crew. The second exception is if an Indian citizen or a person of Indian origin is coming India on personal visits and his total income is less than 15 lakh rupees, the 60 days third rule is replaced with 182 days. And if his income is more than 15 lakh rupees, then the 60 days gets replaced with 120 days. These are the only two exceptions to the third rule. Otherwise, there are 3 rules to determine the residential status. Who's a deemed resident? A deemed resident is an Indian citizen who has income more than 15 lakh rupees. Here total income means Indian sourced income. So if his income is more than 15 lakh rupees in a previous year and he's not liable to pay tax in any country of the world, he becomes a deemed resident. Now, when a person is a resident, then he needs to get classified into resident and ordinary resident, ROR, resident but not ordinary resident, RNOR. Now, who's RNOR? Other than people who are RNOR, he'll become ROR. So RNOR is a person who was a non-resident in past 9 years out of the 10 years. Or his physical presence in India is less than 730 days during the 7 preceding years. He becomes a NOR. A Indian citizen or a person of Indian origin who has income less than 15 lakh rupees is not considered here. But who has income more than 15 lakh rupees and his stay in India is between 120 days and 182 days, he becomes an NOR. So this is this condition where a person of Indian origin having income more than 15 lakh rupees and he stays between 120 days to 182 days, he becomes a non-resident. Last condition is a deemed resident will always be considered as not ordinarily resident. In this manner, we need to calculate the residential status. Now, what is the difference in between if you are a resident, non-resident, deemed resident, RNOR, etc.? If you are a resident, your entire global income gets taxed in India. If you are a non-resident, only Indian sourced income gets taxed in India. And if you are a resident but not ordinarily resident, then Indian sourced income gets taxed in India, plus any business or profession which is controlled or set up in India gets taxed in India. This is the difference between the three residential status. The next is perquisite income. If any employer is giving free food and beverages to their employees via paid vouchers, then that will become a perquisite if the employee goes for the new tax regime. The next change is, we all know how PF works. There is employees' contribution, there is employer's contribution. So employer's contribution is always exempt. And employee's contribution gets a deduction of 1,50,000 rupees in section 80C. Now, they have put a cap on employer's contribution. The act says that if any employer is contributing in these three funds in aggregate or individually more than 7,50,000 rupees in a year, the excess contribution will become taxable in the hands of the employees. And any income on that excess contribution will also become taxable in the hands of the employees. So to calculate the excess contribution and any income on that excess contribution, they have given a formula. The next change is with respect to tax audit under section 44A. So the limit of tax audit is extended from 1 crore to 5 crore if a person satisfies both the conditions. That is, cash receipts is not more than 5% of the total sales and cash payments are not more than 5% of the total payments. If both of these conditions are satisfied, then the limit is extended from 1 crore to 5 crore, otherwise it remains the same. The next change is with respect to the donations that you made in a trust which is eligible for ATG. So now if you're making any donation, you will not get ATG deduction until and unless you have a receipt from that trust. And the trust who's receiving these donations have to file a statement, that is Form 10BD, saying that these many donations are being received by the trust and these are the donees. So these provisions are applicable from financial year 21-22. But we need to be careful while making donations that we are supposed to take receipts, otherwise we will not get the tax benefit out of it. The next change is with respect to due dates of filing the tax returns. So the person who is required to get his account audited, the due date to file those tax returns is 31st October now. And for TP cases, the due date is 30th November. Next section is for non-residents. A person who is a non-resident and has income only from 4 sources of income, any of the one or all the 4, that is dividend income, interest income, royalty and FTS, then that person is not required to file return under section 139(1). because TDS must have already been deducted by the pay, and hence the person is not required to file the taxes. So this was all with respect to individual taxation and changes that happened in Finance Act 2020. I hope it was useful. If you have any comments or any confusions, you can put it down in the comment section. Please like and subscribe if you like the video, and also follow us on any of the social medias that you want to connect with. Thank you so much and have a good day.